QuickBooks Online 2025 Report Formatting Basics. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are online in our browser, searching for that QuickBooks Online test drive, the free sample company file available to everybody. Looking for the result that has Intuit.com in the URL because Intuit is the owner of QuickBooks. We're going to be choosing the United States version of the software. Verify that we are not a robot or else they won't let us in. It's just like that bar in Star Wars where they don't let you in if you're a robot. They kick you out, so you have to at least say that you're not a robot. And so we're in the sample company file, Craig's Design and Landscaping Services, opening the major financial statement reports as done every time. The reports, they're on the left-hand side. As we know, we're in the standard tab. Favorites, right-clicking on that balance sheet so we can open that link in a new tab. We're going to do the same for the profit and loss, otherwise known as the income statement. Opening the link in a new tab. Let's go to that middle tab, close up the ham boogie and change the range to that 2-year time frame as has been our custom. 010124 tab, 123124 tab. Dropping down to see it in years. Run it to refresh it, por favor. And so there we have it. I wanted to go to 2025 though. Let's fix that. Hold on a second. 2024 to 2025. Let's run it again. There it is. 24, 25 side by side. Let's go to the right and repeat. Closing the booger of hams, closing it and changing the range. 010124 tab, 123125. Drop down years. Run it to refresh it. And there we have the year by year breakout down below once again. Looks like there is more activity now in 2025 as QuickBooks possibly updates their sample file for the current year, but we will continue to refresh the report between every presentation, opening in incognito window as we recommend you do as well, so we're as close to the same data as possible, not having prior presentation transactions being recorded in the report because of that refreshing process. Let's go back on over to the balance sheet. Last time we focused in on the general concept of the balance sheet and the overview of it, remembering the balance sheet, the income statement, those aren't just reports. Those are the financial statement reports. Those are the main reports. Those are everybody's favorite reports because that's the end result. These are the things we're trying to construct in order to do what we need to do, which typically is going to be at least tax preparation in the United States for income taxes and possibly needing these reports for external reporting as well as internal types of decision making. We now want to start to think about what we can do to these reports, what the customization is, which is going to be in this basically ribbon up top. We have the items in kind of the grayed out ribbon over here, and then we have the more customized options on the right in this customized field. And currently we have the switch to the modern view. It's possibly a good idea to go into this because this is what they're A/B testing. So I switched it over to the modern view, which looks like it's what they're kind of leaning towards us moving into. So you would think possibly they might have just the modern view at one time after they do their A/B testing. Noting, however, we could switch back to the classic view here and we might take a quick look at both of them just in case they choose A versus B on the A/B types of testing. But this is a little bit cleaner and I think it's got a little less repetition than the classic view. So let's take a look at it here. So we've got the report periods. Now note, as we go through this, we're focusing in on it for the balance sheet, but most of these options will be the same for all types of reports, although we have to be careful for certain things which will be different from report to report. Noting here on a balance sheet report, we're reporting information as of a point in time. Therefore, as you can see, when we did this comparison, it basically just has two columns because it's the point of time 12/31/24 and 12/31/25. Whereas if I go to the income statement, this is what we could call a timing type of report. Let's go ahead and switch this to the modern view as well. So we have a timing report, and notice you have an extra column over here. Why is that? because this is showing the performance over a time frame. It needs a beginning and an ending period. We'll talk about income statement reports a little bit more later, but as we think about the customization up top, it might look a little bit different if you're thinking about a report that's going to be reported as a point in time versus a period or a time frame like a profit and loss report. So I just want to kind of keep that on mind or in mind. Let's go back on over to the balance sheet. So we've got the period. So when we hit the drop down here, we can choose the custom period, which is what we have been doing, and then we've been tabbing through, and we chose a 2-year time frame in our case to show 2024 and 2025 side by side. Oftentimes you might be just looking at one period at a time, basically 1 year at a time, in which case you might use the default type of settings. So you got the custom dates, you've got today. If I go in today to today, it's January 27, 2025 over here. So that means, again, this being a report as of a point in time, is going to show that as of this point in time. It doesn't matter what the beginning date is. Notice I don't need a beginning date on the balance sheet. Whereas if I do that on a profit and loss, just for comparison's sake, profit and loss or income statement for today. Now this should be giving us the what is happening, the activity, I believe, just for 1 day. So that's possibly not as useful on the income statement, because usually we want a range that's going to span at least a week to possibly a month to a quarter to a year. Let's look at the next one down. If I go to the balance sheet and I look at this week, then what are we going to get on the balance sheet? Notice it's at the end of the week, so we're not there yet, but it picked the ending point of the week, February 1st. Now this is being reported as of February 1st. It's not a time range, so there is no really beginning date, right? It's not for the week end. I don't need a starting point, right? I just need that ending point. Whereas on the income statement or profit and loss, by comparison, notice now it has given me a range, January 26th to February 1st, and it's given me the activity, what has happened during that time frame. So again, the point is, income statement, I need a range. I need a beginning date and an ending date. Balance sheet type of reports are as of a point in time. This is this week to date. So now we have the week to date, and then we have this month. So this is going to be the current month. So these are just, I could choose, the current month with basically a custom range to help me to pick that out. But here we have just the month. If I pick that over here, this month, then again, it's going to give me the activity for the month. If I go back on over, and we're going to say this month to date, then we have the quarter, which is the other way to see things, remembering that there's 12 months in a year. So if I divide 12 by 4, we get, the 3 month quarters. And then we're going to say this quarter to date, this year. So this is going to be fairly common, right? So now we're going to get the full year's worth of data for the current year that we are working in, which means basically as of the end of the year. Now notice if I go into the checking account here, then we get to what we might call a general ledger report. And notice the range here is January through December. So let me just show you that again. If I go back, notice that the balance sheet is as of December 31st, 2025. This only needs one date. It doesn't matter what the beginning date is because it's as of a point in time. But the range becomes important because if I say this is a year, then when I go into the detail, like I often will when I'm kind of working on things, I'm going to want to go into, say, the checking account to see what I posted, get into, in essence, a general ledger type of report, which they're calling a transaction report. This is a timing report, which gives me a range from January to December. So when I look at a balance sheet, adding a range is important, not because it really has an impact on the balance sheet, which is reported as of a point in time, but because when I use it to drill down like an auditing process to the general ledger or transaction report and further down into the source documents, the forms that created it, this report will be given the range, right? So that's going to be useful. So then we have this fiscal year to date, yesterday, recent, last week, And so now we can go into the last time periods like last week date, last month to date, so on and so forth. And then we have last year. So I could just go right into here for last year for 2024, last 7 days, last 30 days. If I wanted to do a comparison of 30 days instead of by month, which is going to be, uneven, 31 days, 28 days, 30 days, last 90 days. Since 30 days ago, next week, next 4 weeks, and next year. So usually you're going to be using something like the year to date or the current year, or you might just simply type it in with the custom date. So I'll say custom date, and then notice I have a range here, even though the balance sheet doesn't have a range. Why? Because if I put a range in going from 01/01/24, let's say to 12/31/24, then it doesn't really matter down here because it's as of December 31st, 2024. But when I drill down, it's going to give me the detail for the time frame. So I have all the information to drill down on. If I don't want a whole year's worth of detail when I drill down on it because I'm working in the current month, I could go back here and just say, what if I made this just for December? This number is going to be the same because it's the ending point. So I'm going to say this is 12/01/24 to 12/31/24. Notice it's the same here. That didn't change. But if I go into it, then it's going to give me the detail only for December. So you see how that range is useful for when I drill down into the general ledger so I can narrow down the amount of activity on the balance sheet. If I do that same thing on the income statement, there will be a change. Meaning if I give a custom date range and I go from 01/01/24 to 12/31/24, then this number is going to differ than if I change this to 12/01/24, because now it's showing the activity for 1 month time frame. I think that differed. It should, it'll typically differ depending on the data input that's going to be in there. So that's going to be the idea on the date ranges. Then we have the accrual versus cash. Now this is one that people often get confused and have questions about, noting that accrual is the default. So as a general rule, you want to keep it on accrual unless you have some reason to put it on something other than accrual. And you might say, well, hey, I want to be on a cash-based system. You might be on a cash-based system based on, the type of industry you're in, even though this is selected an accrual basis. So let me show you what I mean over here, because again, a lot of people will have questions about this, and it'll come up for taxes as well, because you might say, hey, look, I've chosen to be a Schedule C on a cash-based system on taxes, so maybe I should toggle this to a cash-based system. So let me give you the idea. I'm going to go to the flow chart over here, noting this is the desktop flow chart, even though we're using QuickBooks Online, because we're just looking at the flow of the forms, which will be the same in any kind of accounting system. So when I say I'm on a cash-based system or I'm on an accrual-based system, note that there are some accounting systems where you can say you're on a cash or accrual and there won't be a difference in the reporting on a cash versus an accrual, because there will only be a difference when there's a difference between when the revenue was earned or the expenses were incurred and when you paid cash for the expenses or received cash for the revenue. So one way we can look at it is to say there's no difference between a cash basis and an accrual basis unless there's a disparity, a difference in the timing of when we earned revenue or when we incurred expenses and when we received the money for the revenue earned and paid the money for the expenses. So they'll be the same. But from a practical standpoint, most people see it as when there's a difference. When that difference happens, that's when we're on an accrual basis. In other words, you'll basically say you're on a cash-based system if you have a simplified accounting system where you receive money at the same point in time you do the work and you pay the money at the same time that you incur the expense, even though it's the same thing. Accrual or cash would be the same thing in that instance. And you're on an accrual system in those instances when there's a difference because it forces you to be on an accrual system. Let me show you what I mean. Let's say we're on the revenue side of things, and let's say that like you're at a cash register, for example, or let's say you're in a gig work situation. If you're in gig work, you're going to get paid during the same month that you did the work by YouTube, or say let's for the AdSense revenue, and you might record it, say with a deposit form. When you get the deposit form, you're going to increase cash at that point in time, and you're going to increase revenue at that point in time. And you could say basically you're on a cash-based system. You're recording it as you receive the cash, possibly with the use of the bank feeds. That makes sense. But you could say, hey, look, I'm also on an accrual-based system, because from the accrual standpoint, I should record the revenue at that same point when I got the cash, not because it's when I got the cash, because it's when I did the work. I did the YouTube stuff and I put it out there or whatever, right? If Google's paying me, or I did the AdSense and so they paid me. So I should be paid at that point in time on an accrual basis because it's when I did the work. I should record the revenue at that point in time on a cash-based system because it's when I received the cash. So it's going to be recording revenue at the same point, whether you call it an accrual or cash-based system, because the receiving of the cash and the earning of the revenue happened at the same point in time. However, let's imagine that you are in an industry where you have to do the work first, and then you invoice the client, meaning you have to track accounts receivable. Well, that's driven by the industry. You're forced to do that. If I'm in a law firm, if I'm in a CPA firm, if I'm a landscaper, that's just the way the industry is basically generally set up. So I'm kind of forced to have this disparity of when I'm going to collect the money, which is after I did the work, and then when I did the work, which is before I collect the money, and the invoice is going to be the form that records the increase in the accounts receivable. So most of the time we would think now you're on an accrual-based system, at least for this part of the revenue cycle, because I have to do this non-cash transaction. I've got to increase accounts receivable and record the revenue at that point in time when I did the work. So notice that forces me to be on a cash-based system just on the industry that on an accrual-based system, just because of the industry I'm in, and because now I have to track then the accounts receivable. If I forced myself to be on a cash-based system, even though I have to track the accounts receivable, that's when that toggle is going to cause something to happen on the form. So similarly, on the vendor side of things, most small businesses are going to pay the bills as they become due, either with a check or expense form that might come through the bank feeds, or with a credit card payment. And therefore, basically, we would say they're on a cash-based system. But you can also say they're on an accrual-based system. It's just that they're paying for the thing at the same point in time that they incurred the expense. It's only when they enter the bill that they're forced to do an accrual thing. Now, there's a difference between the point in time that you incur the expense and when you're going to pay the expense, and you have to deal with that accrual component of accounts payable. So what that means over here for reporting purposes is that you don't need to toggle this to a cash-based system if you're on a simplified system. If, for example, you are recording all of your transactions with deposit forms as they clear the bank account, and recording revenue when that happens, and you're recording your expenses with expense type forms as they clear the bank account with bank feeds, then you're on, in essence, a cash-based system, because you're paying for things and receiving things, the money at the same point in time you earned the revenue, and at the same point in time you incurred the expense. So it shouldn't, in that case, do anything. There won't be any difference if you toggle this from a accrual to a cash-based system, because you're in a simplified system that doesn't have a timing difference between when you receive money and when you pay money, when you earn the revenue, and when you incur the expense. But if there is a difference, that means you're going to have accounts receivable here, for example, and you want to track accounts receivable. You're forced to do that. So the only time this would make sense is basically if you're saying, hey, look, I have an accrual thing that I did, like accounts receivable, And I would like to transfer this as though I was on a cash-based system, even though I have this accrual component. What would happen then? Well, then the accounts receivable is representing the revenue that was earned, even though cash was not received. It's going to reverse those. It's not going to record revenue at the point in time you enter the invoice, but it's going to record revenue at the point in time you received the payment. So therefore, this accounts receivable should go away in essence if I toggle this to a cash-based system, right? So now accounts receivable is gone. So that's when you might use this. Now note what you're doing when you do that is kind of like you're switching to basically a cash flow basis, which is kind of what the statement of cash flows does. So you will recall that we have the two major financial statement reports, balance sheet, income statement, or profit and loss, and then the statement of cash flows. So that's an attempt to try to get the best of both worlds of having an accrual system, which is typically better for comparative performance purposes, particularly on the income statement, and then also be able to convert that to a cash flow system so that you still have the cash flow component. So in essence, what you're doing when you toggle the income statement, for example, to a cash-based system is you're kind of making a cash flow statement in essence, right? Which you already have kind of a cash flow statement if you, at least in an indirect method. So that's kind of the idea. So the basic idea is you usually want this on an accrual system, even if you have a simplified system that's basically equivalent to cash. And so if you're thinking you need to switch that to a cash system, check with your accountant and whatnot, because typically it's not the case. All right. So then we have the view options. So we have the compact view versus the normal view. So it's just going to give us a little bit of a spacing difference. I think the compact view is the default. And then we have the expand all and collapse all. So if I collapse, now it's taking all the triangles down. So now I'm going to expand all of them. So now we have expanded all of the triangles. So that's something that you can kind of do manually. We did that in prior presentations to collapse the triangles here and expand the triangles. Remembering that these little triangles, what are they? They're either class categories of the financial statement, like assets is a normal category, current assets is a normal category, and then down here, these triangles are based on the type of the account type when we set up the accounts, bank accounts, accounts receivable from the general ledger. And then if there was another triangle, that would be for sub accounts that we can create sub accounts for. So then we have the display. So if I go into the display, now we've been looking at it basically in years. So we could look at it, say, in months versus the years. Now, of course, there's only 1 month. Let's change it. Let's go from 01/01/24 to 12/31, and that's going to give us all of our months. Now, this is what I've been looking at, the classic view, because that's been the default, so they're still kind of testing this out. So we've been doing this. If I switch this back to the classic view, notice what we have here. You've got your custom. Now you have your date range up top, and then this was the display column, where we've been switching it to years, which is going to give us the two columns that we were looking at before for 2024 and 2025. If I switch to the modern view, then that's in this display area. So now we have the years drop down here. Let's go back to the custom. Let's go up top to the custom date so we can mirror the similar type of thing, 01/01/24, and then we went to 12/01/01/24 to 12/31/25. And so here's the 2 years. And then, so if I wanted to see it in days, that of course is not typically what we do, because that's going to be a very long report as it puts the days atop the top column. Months is fairly common, although that would usually happen if you're going to be looking at 1 quarter date range and then possibly look at it the months in that quarter, or for an entire year. Quarters, which is going to break it out into 3 months time period: January, February, March, April, May, June, July, August, September, October, November, December, and so on. And then we have weeks that we can break it out within. And then we have the years that we've been using. And so we have the 2-year time frame, and it's breaking it out between the 2-year. We can also break it out by product and service. A little bit, well, a lot more unusual to do, but possibly something that might be useful. This is something that you possibly do more likely on a profit and loss report, breaking out the income statement by the things that you're selling. And then we can break it out by vendor, which again is something that you possibly do more on the income statement, so that you can break out the income statement expense accounts by who you bought them from. So typically we're going to be up here in the date, and then we have the customers. So you could break it out by customer as well, which once again is more likely something that you would do on the profit and loss report, breaking out columns of your income statement, broken out, say, by who you got the revenue from, for example. Let's bring it back to, let's just say, years. And so there we have that. All right, closing that back out. So the next thing we have is this compare item. So now we can compare time periods side by side. So to the previous year, previous period, and custom period. Now we'll talk more about creating these comparative reports later, but you'll recall that we made this comparison by basically just selecting a 2-year time frame and then displaying it in years, which gave me this breakout. So that's one way that you can do a type of comparative report. Notice when you do this, it shows from left to right, oldest to newest. If I compare this way and do this comparison, it's going to give me let's change this to 2020. Let's change this to 2025. So January to December 2025. If I look at the previous year here, then it's going to give me the current period and the previous period for 2025 and then 2024, meaning it shows the most current period first. I can choose the previous period, which will be similar. We'll talk more about that in future presentations. And then I have a custom period, and then we could calculate the variance. Now notice the first method that I used, if I had 3 years comparison, then of course I couldn't really subtract the two. But if I'm comparing just 2 periods, like last year and this year, or last month and this month, last quarter and this quarter, then I can look at the dollar change, and then I can look at the percentage change. We'll talk more about that later, how to calculate those percentages. And then in certain instances, you might have the percentage of a row and a percentage of a column, which can help us to make some comparative reports and vertical analysis type of reports. We'll talk more about those later. These are tools that allow us to do a lot of those comparative reports that sometimes QuickBooks puts in the reports areas as reports that have already been created. If we understand how to use or make the comparative reports, it's a lot better because we have a lot more flexibility to customize the reports that we want to create. Let's close that out. We've got our filters up top. Now, usually the filtering options are what you're going to use like on transaction detail reports, but it'll give you your filtering options up top here, and vendors, and so on and so forth. But again, usually this filter report will be in something like if I go into, say, the checking account, now I'm in a transaction report, and oftentimes there's going to be a lot of detail within the transaction report. So I might then filter within the transaction report by the transaction type is often most common. Now notice it already has a filter of the account. So that's kind of there by default in this new view because we're filtering by the checking account. So if you also then want to filter again by the transaction type, you want to add another filter, and then we'd add and filter by transaction type, for example, boom, possibly most common, and then maybe have it equal to, and then maybe we'll have it equal to a check form. So then we'll add the check form. What happened? Check form. Now you could have multiple things that you could check off too, instead of just one, and that gives me a filter down. So that's often, again, useful in long, detailed reports like general ledger type of reports, which are typically these transaction type of reports. And then, of course, we can add other filters. We can basically filter by the headers up top, which would give us the date filters, but we have the filters of date up top. So the transactions possibly the most common. Numbers could be useful. Names, things like customers, vendors could be a useful filter, as well as the memo. And then the account could give us a filter type as well in terms of the other account affected. But if there's multiple accounts, this will be a split. So that's going to be the filter options. Let's go back, exit without saving. We're going to do that. And then we've got the general information. So we're going to go into this more in a future presentation and get into more of these options. So we'll take a look at that later. Let's close that out. We've got the more actions to add a note. So we have a new option that we can add a note down here. So if we wanted to put a little bit of customization in our report, we have the note adding. And that's a new one, as they say here. Export to Excel. So that's quite useful if I want to do more customization. Then, of course, I can export it to Excel, which is a way that I can then display it to somebody or give it to somebody. But it's also a way that I can do a lot more customization than I can within QuickBooks itself, like customizing the fonts or the color of the text and so on. The problem with that, however, is that every time I do the report, I would have to export to Excel in order to do that further kind of customization. So you might want to do that a little bit, because just a little bit of customization, a little bit of fonts beyond what could be done in QuickBooks could make you stand out a little bit, because it's going to give you some differentiation. But you don't want to get too extreme, because generally you'll have to do those customization steps every time you process the reports. Whereas if you do the customization within QuickBooks, you can save the customization that you can do within QuickBooks and hopefully not have to do it every time. So export as a CSV, which is basically like an Excel file that doesn't have the Excel formatting. You can think of it as, generally it's a comma sliced data. So it just has the data in it. So if you wanted to just have the data, then that might be useful if you're going to import it somewhere else that doesn't want the formatting of an Excel file. Now, you can print and save it as a PDF. That's going to be quite common if you want to save the report as a PDF to most likely give it to somebody else, remembering that if you're providing this to a client or supervisor, you have to think about the best formatting to do so, because the presentation and packaging is usually a big deal, right? It's gonna give people confidence or lack thereof in you. So we'll talk more about maybe the best way to package things later. We can email the report, which again, we have to think about how we're going to email in it, because if there's multiple reports and you email like 10 different reports as an attachment, that might not be as efficient or nice looking as if we were maybe to export as a PDF, combine them at least into a zipped file. So we give them at one time in a zipped file, or possibly put them together in a formal report as in Excel or in QuickBooks has the report function, or possibly we export them to Excel and use Excel and Word to make a more customized report. So those are some options we'll talk about later. Schedule a report, add to management reports. The management reports are going to be one of the things that QuickBooks has to group reports together in a little bit more formal style. So again, that might be one option to provide the reports in a little bit more formal type of way. We'll talk about those options more in future presentations. So we went through these. You can refresh the report down here. So this is like the run button now. We have the refreshing of the report. So every time we go back to the first tab and back on over, instead of hitting the run button, we might hit the refresh button if they stick to this style. Let's take a quick look at the classic view just to do a comparison over here. So we don't know exactly where they're gonna land between the two. That's why we update these each year, but it's basically the same options here. Now you've got your customization. Here's where the years, the display options. Here's where you have active. Now, this one is also in the customization, so we'll talk more about it later. This is one they removed from this bit because I think it's already over here in customization, so that they cleaned it up from the modern view to give us a little less space. This one we saw was the compared to another period, the previous year. Here's the dollar change, the percent change. And then you've got the accounting toggle that we saw, and then the run report instead of the refresh button. And then you have your collapse item here. Then you have your sort. Now, this one, I believe, also is going to be in the customized area. So they took it out of the modern view because it's going to be in here, I believe, as well. Here's where the add notes were, edit title. So you can edit the titles here. Again, I think that's going to be also in the customized. So the old view, the classic view has some repetition in the standard view and in the customized, which I think are some of the things they cleaned out in the more modern view to make it a little bit slicker looking here, and then have those other options in the customized. So then we have the title. You can email it. Here's the email option. Here's the print, and then here's the export to Excel, export to PDF, add to manage reports, and then the cog button has the compact view versus the non-compact view, and you could click in here adjusting the title. And then the other options in this view is in the customize options, which looks like this. So this is what we'll get into next time, but you could see there's a little bit of repetition here with the, for example, the classic, the cash versus accrual and so on, has some duplicates, which I think they cleaned up a bit again in the modern view. So this is what we deal with QuickBooks Online. These options are basically the same. You can see that the options haven't really changed. It's just surface formatting typically on where things are located and kind of the slickness of the bar that they're trying to A/B test. That's typically what's going to happen. That's typically one of the reasons that, again, we update the course each year so that we can try to keep up to date with the new looks and feels. But just remember, as they change the look and feel, it doesn't change the double entry accounting system, right? Everything's basically the same. It's not usually that they're adding new functionality or taking functionality away. They're just changing how you get to that functionality. So if you keep that in mind, then hopefully it'll help people not to panic every time QuickBooks makes a change to their web page. If you're used to QuickBooks Desktop, then you might panic every time they change something because the desktop version was the same for like ever, like the entire existence of the thing. Whereas QuickBooks Online is basically a website which they can change all the time and are typically going to try to A/B test all the time. Even, like I say, even if they got it perfect, I don't think they would stop there. They would keep changing it because that's what web designers do, right? So it's always going to be changing, it seems to me, but that is what it is.